Hello, everybody. Welcome to Cornell Cooperative Extension's Consumer Issues Talks. My name is Kenneth McLaurin, the financial management educator here at Cornell Cooperative Extension. Today we have with us our Assistant Attorney General, Mike Danaher, and he will speak to you folks on the ins and outs of insurance. Thank you very much, Mike.
Thank you, Kenneth. Hello, everyone. Welcome to Cornell Cooperative Extension for our monthly consumer issue program. We're going to talk about an issue that a lot of people really don't think enough about, which is the ins and outs of insurance. I know we talk, whenever somebody starts talking about insurance and that sort of thing, that everybody's eyes roll up in the back of their heads and they say, well, it's just whatever I have. They haven't really spent a lot of time thinking about it or going into it. But like a lot of other consumer-related topics, insurance is something that we need to be good consumers about. We're always challenging consumers to be good consumers in the marketplace, to know what their rights are, as well as their responsibilities, no more so than when we're looking into issues related to insurance products. Now, this is probably a good time to be talking about these sorts of things, or maybe a bad time, depending on how you look at it, because they're all in flux about this health insurance thing and whether or not, as we tape this, they're in the throes of battling in Washington about whether to repeal and replace the Affordable Care Act, or to modify it, or to do whatever. We're not going to get into that discussion because it really doesn't make that much difference for you and I, actually. It's just, at least for a part of our discussion is what can we do regardless of what's out there, whether it's the Affordable Care Act or some iteration of that we be a good consumer when it comes time to choosing insurance. And although we think a lot about the health insurance issue because, one, it's so expensive, and for some difficult to obtain, and expenses associated with health care without insurance can be devastating to someone. It's more than once put people into bankruptcy because of extensive medical expenses that were associated with it. But there are other insurances that we should also talk about and that people need to understand in order to be good consumers. Most of us are not experts when it comes to insurance. And when you think about it, insurance is really one of those things that we need, but until we have to use it, it's not something that we want. We don't want to have to spend money for something that we don't know that we're necessarily going to have any benefit out of, and so we don't want to think about it. There are other things that we talk about, other products and services that we actually want before we get them. Insurance is different in that we really want it after we need it. So we have to think about it ahead of time. We have to think about before the need arises, or the immediate need arises. I think the nature of insurance is that we really need it. It's just the question is that we don't think about that need until actually we have a car accident or a medical bill or something breaks or whatever. If we usually other products such as cars and computers and houses and those sorts of things, we really want those things before we may necessarily need them. We want that new TV. May not need it right away, but we really want that sort of thing. You don't hear people saying, yeah, I really want that insurance. I really want that life insurance to protect me. So it's a little different way that we look at it. And we do have to say that once we have it and that we need it, we are really glad that we have it. Use examples of, in some instances when I purchase vehicles, I purchase warranties, which really in essence are insurance. If something breaks, absent a deductible, we don't have to pay anything to have the item fixed. And I remember, although I just recently got a new car, the car I had previously, I was hemming and hawing, do I get an extended warranty or not? And that's a whole separate issue and really a decision you have to make as to whether or not. But for these particular purposes, I got it. I was buying a used car, so I thought, it had some miles on it. I didn't know how it was being used, so I ended up buying it. Well, something went wrong with it within a year or so of getting it, and that particular item would have cost me to have it repaired more than what I actually paid for the warranty associated with it. So boy, I was really glad that I had it at that time. Wasn't really glad when I had to pay for the warranty when I originally got it, but I was happy that I had it once I got it. So that's a decision that we have to make as we go along. We have to be a good decision. We have to be a good consumer in making that decision. None of us really wants to spend money for this. We would just as soon not have something happen that needed us to have insurance. But and I think that's fundamentally because with a car you can drive it and it's really nice, and with a television you can watch it. It has really clear picture. It's a big screen, and the computer works really well, that sort of thing. But with insurance, you buy it and you don't know what you have. You can't touch it, you can't use it until such time as that you absolutely need it. We're glad when we have it, but again, we don't use it. We don't need it till we have to use it, and so consequently, we may not spend enough time evaluating what our needs are, determining what the best is for us, and actually just being a good insurance consumer. Let's step back and think about what insurance is. Insurance is really a product that is designed to protect us in the event of a financial loss. The root of insurance is insure. And I looked up the definition. It's to make certain, especially by taking necessary measures and precautions. So it is protecting us in the event of a financial loss later on. Insurance is simply a contract, a contract that provides us coverage whereby one party, the insurance company, agrees to indemnify us, guarantee or protect financially against a loss because of a specific contingency or peril that may occur. So we have to understand that insurance is for protection. It's to protect us. It's not an investment for the most part. And we had a situation, those of you who are my age and older probably remember this, back in probably in the mid to late 80s, where we had these things that were being touted as vanishing premium life insurance policies, which meant that, presumably, that the premium vanished. So you would pay money over a certain period of time, and then at the end of that period of time, you would have this coverage for the rest of your life or until whatever age the insurance went to, whatever it was, 70, 80, 85, whatever. And the talk was that, well, we take your premiums and we invest those for you, and they accumulate over a period of time to where they are generating enough income to cover the policy premium, so it disappears. Well, as it turns out, the estimates that were being made as to what rate it was being invested at were unachievable. And at the end of the 5 years or whatever period of time it was that your premium vanished, I know I had one. Luckily, I knew what the deal was, so I knew going in what it was. And frankly, I didn't have any expectation of having my premium vanish. What I figured I was going to do is I'd just keep paying that amount every month, and the balance of it wasn't a huge life insurance policy. Maybe it was $100,000, $200,000 for a young person. That's not a lot, but that over a period of time that would start to accumulate. It might be 200, 300, 400, 500,000 over a period of time when it might ultimately be needed. However, it was being sold to people as kind of an investment. And it's not. I mean, there are other investments that are available out there. I mean, there's these annuity policies that people can buy and things like that. My recommendation is that you use insurance for the purpose for which it was designed. Being a good consumer, following through on the fact that it is to protect you from an eventual peril. Hopefully that doesn't come about, but that it is there just in case. So it's not, an insurance policy is not used to generate income later. It should not be viewed as that. View other things for that, but view insurance for the purpose of protecting. And there's many, many different types of insurance products that are out there. And we'll talk about a few of the common ones. And the most common one, I think, and the one that immediately jumps to our mind other than healthcare, is auto insurance. And why does it immediately jump to our minds is because that if you own a vehicle and put a vehicle on the road, you are required by law to have at least a minimum of insurance. And the auto policies protect us for property damage and other injury that might be sustained through the use of every motor vehicle. I believe the coverage minimums are you hear 2550 or 50-100 or something like that. What that means is that the first number is if one person is injured in the accident. So for a 2550, and I can't remember what the policy limits are because the policies I've made larger than what the minimums are. And I would encourage most people that, assuming you can afford it, depending on what your assets are and what your liability and exposure and things like that, you know, adjust those accordingly. But let's assume that it's 2550 or 50-100. Let's say 50-100. What that means is that the person who has the insurance is insured up to $50,000 for one person being injured in an accident, and they're covered up to $100,000 for the total number of people who are injured. So if one person is injured, their coverage is up to $50,000. For protecting against a loss. But if 5 people were injured as a result of your operation of that vehicle, the maximum exposure your insurance company has is $100,000 total. That's all that the policy is going to pay. And so people need to seek out what it is that they're trying to protect. Being a good consumer, find out what they're being protected. There's an aspect to all of our automobile insurance policies called no fault, which means that to a certain extent you are covered under the terms of your own policy regardless of who is at fault. So if you were at fault and you were involved in an accident, you would be covered under your no fault portion of the policy. If somebody were to hit you, for the first certain amount of money, you would be covered under your own policy. There are serious, serious consequences for those who do not have insurance. If you are, say you're deciding, I'm going to stop driving. I live in the city of Ithaca. They have good mass transit, or I can use a bike to get to anything I need, the store, library, whatever. I'm going to get rid of my car. Well, make sure that that you turn in your license plates for that car and cancel the insurance, because if you don't and you just cancel the insurance but the plates don't get turned in, that period of time for which you're technically deemed to not have insurance on this vehicle, because the plates are still out there, DMV thinks, hey, you know, they had the vehicle, it should be fine. If you cancel that insurance policy and there's no coverage there actually can be a period of time where your license gets suspended because you do not have it. And if you want to reinstate your driving privileges, you have to pay a significant penalty for that. Not to mention, if you're driving around without insurance on your vehicle and there is an accident, there can be serious consequences criminally for operating a vehicle without insurance. So that's really important to make sure that they have those. There are other aspects to every auto insurance policy you can get. As somebody said at one point in time, many people have said at one point in time, you can get insurance for anything. It's just a question of how much you're willing to pay. There's somebody that always will insure something as long as you're willing to pay what the price is. And of course the price is a function of what the risks are associated that the insurance company is going to have to pay out. So if you're more risky, you have the chance of whatever policy is you're getting to end up costing you a little more money than what it might cost for somebody that is less risky. But there are other things that you can get on your policies. I have, for very, very little cost, I have towing insurance on my car, so that if I have to be towed somewhere, I have coverage under my insurance. Some people have on their insurance policy glass protection. If a rock comes up and cracks your windshield or something, they have protection for that. So there's all kinds of different protections that you can get. And so it's important for us who are going in to get an insurance policy, an auto insurance policy, that we understand what the different options are, what are the costs associated with that, and then make the decision as to whether or not it's appropriate for our particular circumstances. There are even issues where if someone strikes you that is has the minimum policy coverage, so they have $50,000, and you get catastrophically injured where the damage is more than $50,000, you can actually add to your policy to protect you in the event that someone who hits you doesn't have the insurance coverage that you have. You can get it. You can get your limits brought up to what your limits would be if you hurt someone else. You can have your limits also apply to you. Again, you have to look into that, decide what works best for you, and choose based on what the expense is. Another big insurance that we all talk about, and those of you that own homes should have, is homeowners insurance. And some people would think, well, homeowners insurance covers me in case the house burns down. And that is true. But they think that's what the main portion of it is. But there is also attached to all homeowners policies that I'm aware of is liability protection as well. Meaning if someone gets hurt on your property, you are also protected as a part of your homeowner's insurance. You should check and see. There is usually with every policy attached a liability component, but it's kind of a set amount. Well, you may be interested, maybe you have a lot of assets that you need to protect, that you would lose if you had somebody sue you for all kinds of money. You should check and see how much liability protection do I have, and maybe make a decision to say, I may need a little bit more liability protection, because if somebody gets hurt on my property, it could bankrupt me. Well, in that particular case, based on what assets that you may have that you want to protect, you may say, well, I want to increase the liability portion of my policy. You can also get coverage under your homeowner's policy with riders attached to it. Usually, again, it comes with some type of minimum coverage for contents. But I can assure you, whatever that is for contents, it's probably not enough. If you've accumulated enough stuff, it's probably not enough. You want to see what coverage is provided and then decide, do I need other things covered? I mean, some people may have high-end stereo equipment in their house where they're really into jazz music and wants to hear every tone and thing in the song. And that's what they're really into. And so they've bought high quality system and speakers. That might if the house goes up or there's a flood and or pipe breaks or something, you might be limited into what your coverage is, so you may want to check that. But jewelry, I know that you can have, if you have expensive jewelry and things, have that insured as a part of your homeowner's insurance policy as well. They attach riders, which are just supplements to the original policy, get those sort of things. As we fall back to what I said originally, which was there's always something that somebody's willing to insure. It's just whether you're willing to pay the price to have that particular insurance. One thing that I want to point out, because it's something that periodically throughout the years has come to our attention in the Attorney General's office about people being sold things, and that is, I'll explain how the homeowner's insurance policy works. It personally had an effect on me, and thankfully I had coverage for it. Is 2 winters ago, our last 2 this winter that we're just hopefully coming out of, and the previous winter weren't bad. The one before that, if you really sit back and remember, we had about a 2-week span where it was brutally cold, consistently in the single digits, if not the negatives. And I know where I'm from, in the Binghamton area, the southern tier area, there are stories in the newspaper about whole neighborhoods whose pipes froze. And in a lot of instances, either pipes froze or they broke. And in some instances, it was the unusual situation where it wasn't kind of an exposed pipe that was in the house or near the house. Lines running from the street to the house were freezing. And insurance policies typically only cover something that occurs within the dwelling. So if the pipe freezes in the front yard, the municipality covers, it depends on the municipality, by the way, but generally the municipality covers the main line that runs out in the street or just off the street. Any branches off that main line from the shutoff, from the branch to the house, is on the homeowner. Somebody has to make a determination whether, what's the likelihood of having a loss as a result of that. But we're seeing, people are receiving cards in the mail, kind of nondescript cards that make it look like it might come from a utility, that may indicate to say that, you need this coverage and things like that. Well, I will tell you, that's from an insurance company somewhere that is sending these things out saying that you really need this particular coverage or not. It's not mandated. It's not covered by required by government or anything, although the card may look that way. It's just something to saying to you, hey, you're not covered from your house to the street. You may want to be covered. It doesn't make any difference to me whether or not someone would entertain that type of insurance. But what I would encourage you to do is look around to see if that's something that you can obtain from your own insurance company as a rider or something like that. And then second of all, do you really need it or not? And I use my particular circumstances. I really had a benefit is I am not covered from the shutoff valve in the street to the house. And we froze. We didn't have water in our house, and we had somebody come in because we thought something was frozen in the house. Well, it wasn't frozen in the house. We were able to determine that it was somewhere between the street and our house that it happened. And just to make it a long story, it was terrible because we ended up having to, there was because it was copper, we had a commercial plumbing contractor who came to our house, and they actually put where the pipe came into our house, they put what looked like glorified jumper cables, a cable. They went out to the outside and they moved all the snow, because we had a lot of snow at that time, and dug down to the shutoff, which is down below the freeze line, which is like 4 feet down. And they stuck the other end of the jumper cable there and ran current through the pipe. And I don't know if any of you know how expensive a commercial plumber can be per hour. It's like lawyers. Somebody had to sit there and watch. And what this did was it heated up the pipe through the, hopefully designed to break the ice jam. And they went all night, and it didn't happen. Or they went into the middle of the night, and then we said stop. That, you know, it's overtime. Plus, I'll tell you what my luck is like. My luck is like my pipes don't freeze during business hours. It's always overtime hours, either nights or weekends. That's when something will go wrong for me. My car breaks down. It's 2 o'clock in the morning. It's not Monday at 10 in the morning. So we had them come back the next day so that we stopped the time and a half at least. And they came back at regular hours the next day, and from about 9 or 8:30, 9 o'clock in the morning, straight through till about 4:30 in the afternoon, and we finally got water. And the way water works is once water starts moving, that's when things will just clear up. It's when there's a blockage that all of a sudden everything stops. If you can keep the water running, you're fine. So we dripped a faucet to let it keep going, and we were done thinking, okay, fine, we got through this mess. My wife and I went to work the next day, and she came home from work and she said, we don't have any water again. So apparently we weren't dripping the water enough to make it run smooth enough. So we had to have them come back out again, and they went a total of probably 12 hours, and it still could not get broken. I said, that's it. We got to do something else. We don't have water. And what we did was we ended up having the commercial contractor dig up our front yard and have to lay a new water pipe. And as it turns out, my insurance company, we were able, the plumbing contractor was able to determine. I had a weird situation. My house being built back in the 60s or whatever, when they built our subdivision, they ran the pipes under the foundation of the house. And I have a basement, so it was under the basement and up through the basement. And they think it bent around near where the garage was, and my garage is half my basement, is the garage. And they think that the copper pipe, when it was getting near the house, raised up a little bit, raised up to where it was close to the garage foundation and into our back room where the water meter was, and it came up right through the floor of the foundation. The pipe was just sticking out of the floor. They think that it was so close to the foundation itself, not your usual barrier, frost barrier of 4 feet, that at some point where it curved in under the garage, that's where it froze. My policy was such that as long as it occurred within the perimeter of the 4 walls of the house, even though it was underneath the foundation, it was still within the footprint of the house, it was covered by insurance. And that was thousands of dollars. So I hate to pay, I pay my homeowner's insurance every 6 months. I hate to write that check every 6 months, but boy, I was really glad that I had that at that time, because it was thousands and thousands of dollars. So just a story about how it's there to protect you in case of a particular peril, and there are different types of options out there. Be a good consumer. Know what you need for your protection. For example, if you have a house that's worth $180,000, you don't need $300,000 worth of homeowner's coverage. You don't. You have to pay a premium on $300,000. So just a word to the wise is being good consumers. Look at your homeowner's policy and see what coverage you have. I would encourage you, one type of coverage that you should have on your house is a thing called replacement cost. You want to have your coverage that will protect you to replace your house. Your house may be valued at a certain amount of money, but it may cost you more to replace it if it burns down. You want replacement cost. And I know from my personal experience, I have replacement cost on my house so that if it goes down, and it'll cover the face amount of your policy. It'll cover the face amount of your policy plus a certain percentage above that even to rebuild it. But the way that my policy was structured, that it, just based on history, except for that period of time when we had the mortgage crisis and it seemed like property values diminished. Not so much in New York. We didn't get caught up in it as much, but in Florida and California, prices were just exploding in houses. Attached to my policy, there was an automatic increase. Every year, the value increased. And I hadn't looked at my policy, but I sat down with my insurance agent a couple of years ago, and we looked at it, and we go, holy mackerel. Based on just increased escalation every year of the value of my home that was done automatically, I looked at it and said, I have much more coverage than what my house is really worth. And so we revalued the policy back down from, I don't know what it was, $300,000 to $200,000 or whatever. I still have replacement cost on it, but I was just paying for that extra amount that I didn't know, and unless somebody looks at those things, nobody really thinks twice about it. So get replacement costs, but keep an idea of what the value of your house is, and look at it periodically. You may be paying more than what you necessarily have to. Health insurance, huge. That's a big thing that's out there now. It's the one we hear about most, especially when we went through the Affordable Health Care Act or Obamacare. It seems like yesterday, but it might have been 8 years ago or so that it was. And now, of course, with the current administration saying that it's going to, in the current makeup of the legislature, that's going to be changed in some fashion. It's still working its way out. The important thing is to look and see what type of coverage that you have and what type of coverage that you need. I'm sure that it'll work itself out. But New York has a website, New York State of Health, that you can go in and it helps you figure out what types of policies are available out there for you under what we currently have as the Affordable Care Act. And you can make a choice. I know that currently, again, everything I have to say is currently because things could potentially change. Currently, there's a penalty that you have to pay if you don't have insurance. That is, again, one of the things that's on the table that they're attempting to change. But there are all different types of health insurance policies that are out there. But depending on the cover, on what you have, it covers all or a portion of two main things. Hospital, or in case you have to go into a hospital and have hospital coverage, and doctor's visits, depending on what type of policy you have. Now you can have prescription coverage too. You can have other insurances that I would consider to be health related, like dental insurance. Again, all those things have to be explored. Typically, the dental insurance coverage, handles rudimentary, basic kind of dental coverage, annual checkups and that sort of thing. If you have an accident and get your teeth knocked out or something, it could be covered by your health insurance policy. You have to check into that. There are government programs or government-assisted programs. Principally, the two are Medicaid and Medicare. Medicaid is for low income. Medicare is for people who are older. And there are different coverages available. One thing I want to point out is there are also private policies, which I think the term is a misnomer because it's misled a lot of people. But they're called Medicare Advantage plans. Actually, what Medicare Advantage plans are is they actually take you out of Medicare. It's kind of a private plan that takes you out of Medicare, so you're getting out of it. That's in contrast to supplemental plans, which you can have Medicare, and then have policies that supplement that. I'm not going to get into the intricacies of that, but I want people to know that there are two different things, and make sure that if someone were trying to sell you one of these, that you understand what it is that you're actually receiving. If you like Medicare and whatever coverage that you have under Medicare, and somebody comes to you and says to you, "Hey, we have this thing and it's like Medicare kind of thing," make sure you know what it is, because if you were to sign up for this particular Medicare Advantage plan, it actually takes you out of what you have and gives you something else. So make sure that you know what it is. Plans are, we know that medical coverage, medical issues are expensive. I know from a personal experience, I just had a hip replaced a couple of months ago. And now I'm seeing some of the bills coming in and go, whoa, that's a lot of money. Consequently, the insurance policies, our health insurance policies, because the medical expenses, are so high, health insurance policies are not cheap. And you really have to understand what it is that what you are getting. I know, I'll use an example again from myself. I remember when I was in private practice before I joined the Attorney General's office, seems like yesterday, but it was over 19 years ago. And when I was in private practice, I paid for my own health insurance. And I had a good Blue Cross Blue Shield, full coverage kind of policy. It was very good coverage. And I had to pay for it myself because I was in private practice. And I remember when I had family coverage because I have a family. I remember when I was just before I came over to the state, seeing what the premium was for that policy, and it was right around $5,000 a year. And I thought, man, I'm spending $5,000. Man, I could use that $5,000 for something else. That seems like a lot of money. I looked more recently. I'm with the state, and we have the state health insurance plan. I contribute to my health insurance because the state doesn't pay the whole thing, but I pay a portion of it. But the portion I don't pay is over $20,000. So $20,000 plus whatever I pay in, and I don't have a recollection of what it is. It's a lot of money for health insurance, and I understand that. So we need to be good consumers when it comes down to shopping for the health insurance policy. Some of the things to consider when whether you go on the New York State of Health or you're talking to a private insurer about getting insurance, some of the things to think about are prescription drugs included? Are physical therapy? Is physical therapy included? What about out-of-network providers? It can get really expensive. I will tell you, I have one child who is in an area where there are no participating providers. So she's covered under my policy, but we have to meet the deductible in most instances before the policy kicks in. We will never meet the deductible. It is thousands and thousands and thousands of dollars. And so who does your policy cover? Are your providers part of that plan so that you're seeing an in-network provider where you only have to pay a copay? And if you end up going to an out-of-network provider, you may have to pay what that cost is out of pocket until you reach your deductible, which could be $4,000. You have to understand that. Is mental health and behavioral health services should be included in the policies. It's mandatory for coverage in New York, and it should be, and there should be coverage. I know our office has brought cases against insurance companies for not covering or not covering completely mental health services. Is maternity, how much and to what extent maternity care and childbirth, other inpatient and outpatient surgeries, those sorts of things. Consider how much of your income can be allocated to monthly health insurance premiums. Compare the plans. What's the premium? What deductible do you have? What copays do you have? What prescription drug formulary, meaning what list of drugs is covered by your plan? And if you're on a regular drug for health issue, make sure that whatever health insurance policy you're searching for covers that drug so that you aren't paying out of pocket. Prescription drug prices are really expensive. I'm going to challenge you. A lot of us are on prescription drugs, and we go, and you're covered by insurance, so what the heck, right? You go there, you pay whatever the copay is, $10, $20, whatever it is, and you get your prescription medicine. And we don't think twice about it. I know with the pharmacy that I go to, it actually is written on the receipt that I get how much that drug actually costs. And you go, whoa, that's a lot of money for this little pill. And I will tell you that drug prices fluctuate markedly from one pharmacy down the street to another pharmacy. You would be astounded at the difference in price. Now, if you're not being a good consumer, you say, what the heck do I care? I have a $10 copay. I don't care what it costs. You should, because the $20,000 a year insurance premium that people have to pay is a function of what the medical expenses actually are. And you might find that your prescription, although your copay is the same, your prescription, that monthly prescription, might be $100 more from one pharmacy to the next pharmacy. Be a good consumer. Check around. If it's the same drug, why pay, or have your insurance company, because we pay premiums to her insurance company, pay $100 more from one pharmacy to another? Check into it. Be a good consumer. Compare prices. Make sure that you check with your provider. So you check with your doctor, saying, I'm signing up for XYZ, this XYZ insurance. I would check with both the insurance company and the provider. Are you a participating provider with this particular insurance? And if they are not, you may say, well, I may have to get a different provider, or I may have to get a different insurance policy to make sure that there's coverage. So again, check with both. Confirm that the plan has a list of participating providers, and make sure your provider is listed on that. Then check with your provider and make sure that they are participating, still participating, and make sure that you have documentation for everything. We want to be good consumers when it comes to purchasing that. There's other types of insurance like disability insurance. Again, disability insurance is merely to protect us in the event of a disability to protect our income. And people have to decide whether or not it's appropriate for them. The one thing I want to point out is that there are different types of disability policies that are out there. There are the ability that, let's say you go and purchase a car and you have a car payment, you might be offered a disability policy to cover your car. Understand that that disability policy that you're buying is called a group disability insurance policy, and it only covers the obligation on the car loan. So that means if your car payment is $400 a month, if you become disabled, a qualifying disability, the insurance company will jump in and make that $400 a month payment for you for as long as you're disabled, or until the maximum payout of that disability policy is. You want to check, if you're getting that group policy, how much does it pay, not only $400 a month, but how much does it pay in total? 400 plus 400 plus 400 plus 400. Because there are limits to those policies. I haven't checked in a while, but at one point in time it was around $30,000 was the maximum of these group disability policies. And if anybody's gone out like me recently to purchase a vehicle, cars are really expensive now. And when you pay it over the length of the car loan at $400 a month, although you may have only borrowed $28,000, your policy will expire before the loan has been paid off, and then it falls back on you. And if you're permanently disabled and you can't go back to work, you may end up defaulting on that loan because there's a maximum associated with it. So you want to see, if you get a disability policy in that context, is there a maximum? How much? How much are you borrowing? And if you pay this every month over the life of the loan, how much will you be paying in total? Because you have to repay the principal and you have to repay the interest. And those two added together, stretched over 5 years, stretched over what I understand is 8 years now possibly to get a car loan, which blows my mind. 8 years for a car loan. $400 a month over 8 years with interest and principal can add up to a significant amount of money, and you could end up being cut off. You just want to make sure. You might be better off. Well, here's the other side of it, of the group policy. It only pays the car loan. And if you pay that over the life of the loan, let's say it's a 5-year loan, as you pay it over the life of the loan, the way these things are written, most of your policy at the beginning, most of your loan payment at the beginning is interest and a little is principal. And as you go through the course of the loan, it goes like this, to where toward the end of the loan, your $400 payment stays the same, but $350 of it may be going toward principal at the end, and only $50 is going toward interest. At the beginning, it was reverse. $350 of this loan payment is interest, and $50 is principal. And then it goes like this till the end of the loan. So if you have this disability policy, let's assume for the moment that you become disabled. For your loan, you become disabled at 4 years and 10 months. And so you've paid this disability policy all the way through the life of the loan, 4 years and 10 months. The only thing that you're going to get at the end is 2 monthly payments, and then it's over. You might want to consider, a little more expensive, but you may want to consider getting a $400 a month disability policy so that you use the $400 how you seem fit. If you become disabled, you'll start getting a $400 a month disability payment. And then you take the $400 and you pay your car payment. You pay your car payment. You pay your car payment. Till it comes to be 5 years and 1 month, your car's paid off, but you're still getting the $400 a month disability payment. Then you can use it for, well, whatever you use. Again, it's a little more expensive than the group policy. You have to see what works best for you and make that determination. The next insurance policy that we're hearing more and more about, again, because of how expensive it is, are long-term care insurance policies, which means that if you can't, you need to go into long-term care, nursing home, for maybe the rest of your life or for rehabilitation purposes or what. But you're going to require long-term care. They're very expensive as well. Very expensive per month to go to one of those. You can get an insurance policy that will cover the cost up to a certain amount, whatever amount of policy you get, to cover the cost of nursing home care, long-term care. And what that does is it protects your assets, because if you don't have that policy and you go into a nursing home, guess who has to pay for it? You do. And it's really expensive. And it can deplete all of your assets, and you may think, well, I want to be able to provide for my kids, I want to provide for my grandkids, and if I have to pay for nursing home care, it's going to eat everything that I own, and therefore I don't want to. Well, long-term care insurance helps to protect your assets, and the only thing that I will say is I think it's really important under those circumstances that you discuss an entire estate plan with an estate planning attorney so they can discuss what your various options are and make decisions as to whether or not you get long-term care insurance or not. Typical to other insurances, the greater the risk, the higher the premium. Obviously, as we age, long-term care insurance gets a lot more expensive because it's coming to that point in time where there's a pretty good chance that we may end up there. If you get long-term care insurance when you're younger, it's a lot less expensive. Because you're going to be paying premiums over a longer period of time. Again, something that we need to consider. The last particular insurance that I'll talk about is life insurance. Life insurance, again, protects us in the case of a loss. There's two main types of life insurance: term insurance or whole life insurance. Term insurance, exactly what that term means. Term. You're covered for a term. And they're usually one-year terms. So you get a term insurance policy. So in the case of you dying in that year, you're covered to the amount of the policy. And at the end of the year, it's over. And so then you start a new year. And if you buy a term insurance policy, it isn't like you get contacted by your insurance agent every year and say, okay, it's time to renew. What you do is you get something in the mail that says, here's your newest renewal. But what you will see with a term insurance policy, obviously, as we age, the risks go up as to the risks go up as to the likelihood that the insurance company is going to be met with a loss during that period. So as we age, the term changes and the risks get greater. So what happens? The premium gets greater as we move along. The older you get, the higher the premium in getting these insurance. So if you're 95 years old and you want to go out and get a term life insurance policy, it probably is going to be pretty expensive, if you can even get it. So if you are young, 20, and you buy a term life insurance policy, it will be very inexpensive. Because when you look at the whole grand scheme of things, the actuarial tables will indicate that you would live a lot longer. If you're 65, it's going to be a lot more because we're aging out. What we have to do is be good consumers. Whole life policies, in contrast to term, whole life is what that term means. It covers you for your whole life. So if you get a whole life policy, it's contemplating the fact that it's going to go for more than a term, more than 1 year. It's going to go till whenever your actuarial life expectancy is going to end, and they price it that way. So consequently, if you're going to die at 85, the actuarial table says that a male at 22 years old is going to have a life expectancy of 78 or whatever. I'm just grabbing these numbers. I don't know. I haven't looked at an actuarial table. So if you're 30 years old, well, if you've been good enough to reach 30, then the actuarial tables may say that you might live to be 79.5 years old. Well, obviously, if you've reached 79.5, there's an actuarial table, so if at least you've reached 79, then there's the probability is you're going to reach 85 or whatever. That's how they stretch these things out. So if you get a whole life insurance policy at 22, the expectation is that you're going to die at some point. I think we all have come to that realization that you're going to die at some point. But so it may be out a ways, but it's going to happen. It's going to happen. So the whole life policy takes into account that you are going to live, but you will die at a certain point in time. So we're going to generate our premiums based upon the whole life of someone. They're going to age, they're going to get older as time goes on, so that's going to increase our risk as well. So the initial premium is going to be higher than a term life insurance policy for a 22-year-old, but not dramatically so, and not anywhere near what a 65-year-old would have to pay, and you spread it over the whole life over your whole life. What those whole life policies do is that they usually pay a dividend. That's where the vanishing premium life insurance policies came in. They were actually whole life policies, but some insurance companies were portraying them as vanishing premium, because what they do is they take your premium, they invest the premium, they use it and invest it, and that money's going to grow, and you'll continue to pay more premiums, and that money's going to grow, so that at the end they'll be able to, well, insurance companies are there to make money, so they have to make some money too. But at the end, they're going to be able to pay the death benefit that's listed in the insurance policy. So what it was originally geared for is to explain in more detail the vanishing premium, what they said was, we're going to take this premium that you have to pay, which is, I'll grab a number, $12 a month as a 22-year-old. And we're going to invest those premiums. And then you're going to add more premiums. And there's going to be a point in time, maybe 10 years out, that you'll have paid enough in premiums and we'll have earned enough in accumulations that every year this is going to spin off at least $12 a month in profits. So you don't have to pay your premium anymore because it'll disappear. Well, what they did was when they made those calculations and they showed me, I went through it. They showed it to me. I was being sold the vanishing premium, although I kind of knew what the deal was. What they did was they said, okay, you're going to be paying $12 a month, and it's going to be invested in at a 9.5% return. Da 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 da. Well, as it turns out, there was no way they were going to get 9.5%. So that 10 years that they said the premium was going to vanish in never seemed to vanish. It kept going out. So that's the thing. Don't be sold on that issue. Be sold on the fact of, I need X number of dollars of coverage. I need it over a period of time. I make the decision, do I want term insurance where it's less expensive now and more expensive later? Do I want a whole life policy that's more expensive now but it'll stay level over the years? And you can say, well, I'm 22, I don't have kids yet, I'm not married yet. I just, whatever I need it for is really just burial expenses or whatever to cover me. But I anticipate that I will be married, and I anticipate that I will have kids later on. What I did was, because I didn't have a lot of money back then, is I got a small life insurance, I got some term, some whole life insurance. And I got the life insurance in such that although it was vanishing premium, throughout all these years, 30 some years, I've continued to pay the premium every whatever, I can't remember how, twice a year I think I get it, or quarterly or whatever. I continued to pay that. And what ended up happening was that I may have had a $75,000 whole life policy. Now I have a $180,000 whole life policy. I got a smaller policy early on, but I've continued it throughout the term to where now I've actually added to what the death benefit is so that my family is protected in the event that something should happen to me. So it's, again, these things that we have to be good consumers and think about and make those choices. As we mentioned, there's many different products, many different risks that need to be covered. We need to be good consumers. First, determine what your needs are. Don't have somebody tell you what your needs are and try to sell you something that you don't need. Know what you need going out, whether it's disability or life insurance or anything else, any other insurance, auto insurance. What do I need covered? And then go talk to the salesperson so that you know where you're at and you know what type of coverage you can get. Shop around. Understand the best company, the best price is not the best company. Make sure that you look into the companies, check their ratings, see what they are. The decision is unique to each of us on what we need, what is good, what is necessary. Make sure you choose what is based on what is right for you. Don't be rushed into it. That's the big red flag in any scams, is timing, which is rushing you into doing something. If you feel pressure, go somewhere else. Report any problems you might have to the New York State Department of Financial Services. They are the ones that license insurance companies and insurance agents. You can also file a complaint with our office, the New York State Attorney General's office. For just as a special thing out there, for those seniors who are always in that predicament, we're a little past it now because people have chosen their policies now, but it's going to be a point in time where you'll choose your policy again at the end of this year, whatever policy is ultimately going to be available. There are people out there to help you In each county, I would suggest that you contact your Office for Aging, and they can give you some guidance as to who the HICAP coordinators are, the health insurance coordinators who can give you some guidance. And what they do is they don't tell you what policy you should get, but they give you your options that you have. I mean, I recently had an issue because I have a child who is aging out of my policy. Our policy only covers them to 26, and he's aging out, and he's still a student. And we had to figure out what type of, what we could do. I had no clue, because I always had my own health insurance, as to what would be available. And I called, each county has what is referred to as a navigator. And I got a hold of who our navigator was in my county, and she was phenomenal. She was great. She knew what was there. She knew, as it turns out, because he has absolutely no income, that he qualifies for Medicaid. And she walked me through the steps of what he needed to do, told him, he went on, he did it, he got signed up, and he's got his coverage now. So there are people out there to help you. If you need assistance, try to find out, for those of you that might be selecting under New York State of Health, look under the, do a Google Bing search, whatever type of search you do. Put New York State of Health in there, and it will direct you to the Affordable Care website, the New York version of it. And it will give you contacts. You can actually go through it and do it yourself. And it'll actually, if you need some assistance in talking to somebody about it, it will actually give you contact information to who your navigators might be, or what agency is governing, has the navigators working with them, and get a hold of them, and they can give you some guidance. Again, from firsthand experience, it was a great experience. I was thinking, oh my gosh, what a hassle this is going to be. It was very, very easy to be able to do that and check into it and make sure. If you have any issues related to this, or related to, actually, if you have an issue related to your something that you think should be covered and is not covered, our office actually has a healthcare bureau. We have a bureau that helps people with that. We have mediators who will assist you on issues related to something that should have been covered and wasn't, and now the collection agency is coming at you because they haven't covered a medical bill. Our office has people that can assist you with that and taking a written complaint and try to mediate your complaint with the insurer. I encourage you to avail yourself of that. If you need to find that, call the general 800 number that our office has, which is 1-800-771-7755. And I believe there's a menu there, and then one of the options might be healthcare. If not, just call us in the Binghamton Regional Office. We would be glad to direct you to our healthcare bureau to answer those. But if you have any other issues related to healthcare or other consumer-related issues, feel free to contact our office. Also, you can contact Cornell Cooperative Extension. They always have people available to help you with their consumer helpline. We also encourage you all to come join us. We are here on the second Thursday of each month at 11 a.m. On Willow Avenue at Cornell Cooperative Extension's offices. We hope that you would join us. It's always great when we have a good crowd that can ask questions and that sort of thing, things that I may not have thought of or I forgot. And so we encourage you to come down. So we hope that you will join us next time. Thank you.